The dollar index has a period of seasonal weakness ahead, and the recent inflation data out of the US has been supportive for those looking for dollar weakness. The latest US PCE print came in fractionally lower than expectations at 0.2 versus 0.3% month on month, and the prices paid component of the ISM on Monday, June the 3rd, also came in lower than analysts were expecting at 57. Now, the seasonal focus for the dollar index has two distinct months. Firstly, the month of June. If you just take a look at the month of June, what you can see is there's nearly a 60% losing streak in the dollar index and an average return of minus 0.20%. And then the next pattern from July the 1st all the way through to August the 3rd is also distinctly weak. Around 55-ish% losing dollar seasonal bias, and an average fall greater than June of nearly 0.5%. So if we do start to see selling and weakness in the US labour market on Friday's NFP print, for instance, we could see a little bit further downside in the dollar index, and these two seasonal patterns are definitely of interest. Technically, we've seen on the daily chart there has just been a breach of this near-term potential daily trend line, price moving down to that support level, and underneath that there's another big trend line on the weekly chart, potential trend line here, and it's just sitting around 1.5% from current prices. So that's a potential target for any seasonal dollar sellers. Major trade risks. There's a massive trade risk with this outlook, and that is that the path of the US dollar is very closely linked to incoming inflation and US labour data. So it'll be very sensitive to incoming data, and obviously there's no guarantee that previous seasonal patterns play out again each and every year. Remember, don't just trade it. Season exit. Come along to Season X to find literally thousands of interesting patterns across thousands of different instruments for you to potentially take advantage of.